Well, good morning, everyone, and welcome this morning. Certainly in Sydney, a fairly wet morning, as per typical of the last few months. I'm Cathryn Carver. I'm the Executive of Global Client Coverage here within the Corporate and Institutional Banking area at NAB, and I'm absolutely delighted that everyone could join. I'd like to begin by acknowledging the traditional custodians of the lands upon where we're all meeting today. I would also like to pay my respects to their elders, past, present and emerging. Today's webinar is the second in our client sustainability series, and the topic for today is ESG and debt. As the focus on global sustainability has sharpened over the past 2 decades, both business and banking has moving towards more ambitious targets in the transition towards a net zero environment. For banks, our approach to ESG, both from our perspective and in terms of our work with clients, has changed tremendously. While the banking landscape has changed, so has our role in helping clients and communities address their own climate and ESG concerns. The regulatory and reporting regimes for banks has also grown in line with client and community expectations. All of these are influencing a growth in the appetite and approach to transition finance as a subset of a growing sustainable finance product category, as well as increasing demand from companies for advice and guidance. In 2021, as part of our NAB climate strategy and in response to our requests from clients, we launched the Bank for Transition Centre of Excellence. The Centre of Excellence includes both bank and client-focused activity, ranging from actively partnering with our clients in their transition planning and financing, participation in a very important strategic setting and major projects with the government, our broader community and wider business market, financial lending commitments for sustainability-focused industries and also in the ESG-related sectors. Our Client Insights series of webinars, events, published reports are an important part of our Centre of Excellence. This is a leading capability among Australian banks, and we invest in the ongoing education of our specialist bankers to ensure all our clients receive the best advice. Our global reach also provides us with access to the latest information and ESG best practice to share with domestic and global clients. The latest report we've developed by our Transition for Centre for Excellence is on ESG and debt. This is about to be released, and today's webinar will share some of the key insights from that report, including the following: looking at the evolution of ESG in banking and the changing role of banking in helping our clients to develop and implement their own transitional strategies. How ESG is being integrated into general bank-wide risk practices. The impact of the bank's net zero commitments and the implications of these for future product and service development, including improvements to the cost and availability of debt. We're also looking at how ESG is being incorporated directly into the commercial activities of our clients. We're also the role of sustainability finance, transition finance, and how these are impacting mainstream banking. Finally, we consider what impacts that has on sustainable finance. The ESG and debt report is the result of a lot of hours of interviews with NAB banking specialists and other external sources. It's unique in the market, and we're absolutely delighted to have this opportunity to share it with you today. I'd now like to introduce Rodney Wallis, Executive Resources, Infrastructure and Government, to welcome our guest speakers. Welcome, Rodney.
Thanks, many thanks, Kath, and a pleasure to be here. Very excited. Just want to extend my welcome to everyone that's joined us today. Very excited to be talking about our ESG and debt report and the latest in our Bank for Transition series. We've spoken to many of our customers throughout the series, and there's a range of wonderful insights coming out of that. And we're also looking forward today hearing insights from the UN Environmental Programme Finance Initiative. Today, the discussion will cover two broader topics. Firstly, how ESG is being incorporated by banks into risk management activities, and how ESG is being impacting commercial activities of banks. In particular, we'll discuss sustainability finance trends. We will be very much considering these topics from the perspective of the impact on our corporate and institutional banking customers. But before we get going and before we get into it, I'd just like to make some introductions. I'm particularly pleased to welcome Sarah Kemmitt, and a huge thank you to Sarah for joining us. I think it's at 10 p.m. at the moment where Sarah is. Sarah is responsible for overseeing and working with the Secretariat of the Collective Commitment to Climate Action, the CCCA, and the Net Zero Banking Alliance, or the NZBA, so these organisations can achieve their net zero ambitions. So these are the two organisations that banks sign up to when making a net zero commitment. And both of these groups are overseen and administered by the United Nations Environmental Programme Finance Initiative, in which Sarah sits. And Sarah's long career has spanned ecological conservation, scientific research and financial regulation. Prior to joining UNEP FI, she has worked for organisations including the Bank for England, the Financial Services Authority, the British Library, and she's founded a community agroforestry organisation, Bangor Forest Garden. So thank you, Sarah, for joining us. We are also joined today by David Jenkins. David is our global lead for sustainable finance here at NAB, very, very well known to many of you. David is an industry leader in sustainable finance globally and well recognised. He is an active member of industry bodies, including the Australian Sustainable Finance Initiative, the ICMA Green Bond and Social Bond Principles Advisory Council and Climate Transition Finance Working Group, the APLMA Green and Sustainability Linked Loans Committee, Climate Bonds Initiative, the Institute of International Finance, Sustainable Finance Working Group, and several other sustainability initiatives. And finally, the last introduction for today, Cathryn Todd. Cathryn joined NAB to establish the Bank for Transition Strategic Insight Series and is responsible for the ESG and debt report that this webinar is based upon. Cathryn regularly presents on a range of topics related to sustainability and transition to net zero and some of NAB's largest corporate institutional clients. Cathryn has over 20 years of experience as a strategist, M&A advisor and ESG specialist, leading these functions for some of Australia's largest asset managers and banks. So just one note, please feel free to enter questions into the chat function throughout the session. That's available to you. We will have time at the end of the session to address those, and you'll also receive this report after the webinar. And so if you have any questions following this discussion or about the report, please reach out to your relationship manager here at NAB, or Cathryn, or David, or any of the other contacts listed. Now, to kick us off, I'm going to hand over now to Cathryn Todd in the first case. Thanks, Cathryn.
Awesome. Thank you very much, Rodney. It's an absolute pleasure to be here. I'm just going to share my screen, which will take a second. And while I'm doing that, I really just want to call out, actually, Rodney, your role in all of this. So the Bank for Transition Insight Series and ESG and debt that we're going to broadly be sort of talking to today absolutely wouldn't be here without the involvement of Rodney, who's been a huge driving force in all of this. Okay, so hopefully you can all see my screen now. Today I'm going to talk through two core topics. First, how ESG is impacting banks' core risk management activities, and we'll talk about this now. And then I'll come back later and touch on how ESG has been incorporated into banks' commercial activities. So, starting with ESG, general ESG and cost of debt. Let's start there. This is definitely a topic that's not always very well understood, but there's some emerging research which is pointing to some clear trends. A bit over 12 months ago, MSCI released a study on this topic, and what they did, they took about 2,500 companies sitting in their all-country world index, and they divided these companies into 5 groups based on their ESG scores. And what they found was that the cost of debt for the companies with the best versus worst ESG scores, there was a difference in that cost of debt of about 80 basis points. So this is very material in the scheme of cost of debt. That study, when they sort of dug into those results, it holds globally across different regions, it holds across different industries. It is worth being aware that this study is from a pure general, like the ESG lens. It's not normalised for different credit ratings. Within NAB, when we look at our client base, and particularly when we look at client groups with the same credit ratings, our observation is that good versus poor ESG and ESG ratings can make sort of a difference of sort of up to around 10 basis points, thereabouts. It's not necessary, it's not a perfect science. What is very clear to us is we expect to see the cost of debt differential increase. And we expect to see that because globally, banks are spending a lot more time and taking a lot more interest in incorporating ESG risk factors into their financial models and into their credit analysis and sort of all their risk management activities. This is not to say they never looked at these ESG factors in the past, but for many global banks, it was far more on a red flag basis, and it's becoming far more systematic and sort of thoughtful. Banks are putting a lot of time and energy into integrating ESG now. So hence we expect to see that cost of debt increase. So that's sort of general ESG, but let's dive into climate specific ESG risk and how we're seeing that impact cost of debt, because this is where the trends get really interesting. So with the 80 basis point difference in mind for general ESG risk, what we're seeing for climate specific risk is that for companies who are very green, with very low or negative emissions, there can be a benefit of say 0 to 10 basis points, but it's on the other end of the spectrum with the really heavy emitters and high emitters where we're seeing the big impacts. And what we're seeing there is cost of debt penalties or brownings of many hundreds of basis points. And there's a great study to start by Nature Energy identifying a 300 basis point difference between thermal coal generators and regular power generation businesses globally. And that's certainly consistent with what we're seeing. And what's driving this cost of debt difference is the banks' focus on companies' ability to decarbonise. And in the future, we certainly expect to see this trend continue, not necessarily broaden, like that, once cost of debt reaches cost of equity, it's not going much higher. Companies will switch to cost of debt, to equity. But we are expecting to see this trend go from, at the moment we're seeing it not completely, but in some companies associated with fossil fuels and very heavy emitting industries, we expect to see it show up in other industries in new ways. And I think Sarah will probably touch on that in a couple of minutes. Globally, banks' focus on decarbonisation has been reflected in their net zero commitments. Today, banks with over 45% of global banking assets have made a net zero commitment, usually to a 1.5 degree carbon budget, which is pretty tough. There's a chart on the top right of the screen which sort of shows how quickly emissions need to come down to deliver on that. And that's off a base. Those commitments are off a base of nothing just over 2 years ago. How much, and with these commitments, I think the next obvious question is how much do banks care about these commitments and how focused are they on these commitments? And the answer to that is probably a lot more focused than they were 12 months ago. And there's a couple of reasons there. Firstly, banks should care about these commitments. They have a big role to play in getting society to net zero. And there's a huge amount of scientific evidence of the impact of emissions on climate. But secondly, for the more cynical out there, there's also been a very significant change in the legal environment over the last 12 months, it's fair to say. Sort of a few facts and sort of data points of this being in Australia, we're the second most litigious country for climate change of anywhere in the world, so second behind the United States. We have the highest level of climate-related litigation per capita. And one of the reasons for the reasons for this is we're seeing global advocacy groups come down into Australia to support some of the cases here to achieve the outcomes they want to be seen to achieve, outcomes that then sort of set a precedent globally. And the reason why that's happening, there's a range of social reasons, but one of the reasons from a legal perspective is that our legal system is one that is quite supportive of the plaintiffs. So, for example, with something like misleading and deceptive conduct cases, there's not necessarily a requirement to prove intent, just that misleading and deceptive activities did happen. And also with some of these cases and there are a few avenues of law that are being used, duty of care avenues, disclosure avenues, misleading and deceptive conduct avenues, and some of them, increasingly, it's expected they're likely to have implications at the board level and potential liability at the board level, as well as damages. So it's fair to say that greenwashing, not the legal term, but you all know where I'm coming from, is being taken very seriously by banks, and banks are increasingly considering, well, what do they need to be doing to deliver on their commitments. So I'll leave it there and hand back to Rodney and Sarah at this point. Thank you very much.
Oh, Rodney, I think you're muted.
Thank you. Thanks, Sarah. Is that better?
Yeah.
Just going to say, with that backdrop, can you tell us what being a signatory to the CCCA and NZBA really means for banks, and what do you see some of the implications of banks' net zero commitments?
Well, thanks, Rodney, and great to have the opportunity to speak to the NAB clients today. Thank you. I would say that being a signatory to either the CCCA or the Net Zero Banking Alliance is really all about taking a real leadership position within the banking sector. And it's a hugely important step in committing to really help the real economy to decarbonise in line with a 1.5 degree scenario and achieving net zero emissions by 2050. And I'd say one of the most important implications is that it's a really important signalling mechanism, because banks can't do this on their own. You know, the transition isn't just down to banks. But by joining those alliances, it's really saying to all of the bank's stakeholders, and that includes you as clients, but also the governments in the jurisdictions where the banks are active and the bank's investors, that, you know, that the bank is really prepared to support this endeavour, which is actually going to be the greatest reallocation of capital that we will have seen, perhaps since, you know, the Industrial Revolution. So, you know, banking has always been about really helping clients to effect change. That is the core purpose of banking. And so, you know, that just shows what a central role banks have to facilitate this economic transition. And I think, you know, bankers have a real special perspective because, you know, we've always dealt with the transition of industries. We've seen lots of transitions of there's shifts from one technology to another and one medium to another. And banks, you know, deal with that credit risk all the time for where companies fail to see a change coming or succumb to like a redundancy or disintermediation or equally if they fail to capitalize on opportunities. So, but what's different about this climate change situation really is it's the depth of change. It's all parts of the economy, all at the same time. And so, you know, this transition to a net zero economy needs to be front and center of the bank's business strategy. And that's really where it comes to you as the bank's clients, because it's going to impact the relationship between the bank and the client, because, you know, climate has to be a consideration that is embedded into every decision going forward. And banks will need their clients to have good transition plans in place. And, you know, if a firm doesn't have a good transition plan, then that tells the bank quite a lot about how alive to the risks ahead that client is and whether they are poised to kind of seize those opportunities.
Sarah, you talked about the signalling aspect and the assisting, you know, clients in terms of the role of banks. But when we look at these commitments and joining these organisations, how do banks, you know, practically achieve decarbonisation in their portfolios?
Yeah, well, it's important to note that this is a multi-year endeavour, and it's not something that can just happen overnight. I'd say what the first challenge for a bank is really to do the carbon accounting on its portfolio, to try and measure those financed emissions, and that really isn't easy. There's lots of data challenges. Then comes the challenge of setting a target that is science-based and working out how to do that. But once the target's set, then the bank has to devise a strategy to how they actually decarbonise those portfolios. And, you know, within the Net Zero Banking Alliance, our emphasis really is on real world decarbonisation. And so, you know, divestment can sometimes be an appropriate strategy or an appropriate escalation stage, but it doesn't necessarily bring about the real world drop in emissions that we need to achieve. So really deep engagement with clients is the way forward, and that means working with clients to help them realise their own decarbonisation targets. And you know, it's really on banks to evaluate the credibility of their clients' transition plans and look at how they'll be achieving this. So you know, banks are going to be scrutinising the capital expenditure plans and all the investments that are being made now to really ensure that these investments are not going to lock in emissions in the longer term. And sometimes that may mean opting for a particular technology or refreshing capital assets, but it can also mean, you know, sometimes keeping existing plant going for a few more years until the green alternative becomes available or viable. So I'd say, you know, it's a real indicator to the bank of the quality of management and the sustainability of the client's business model in the future. And, you know, some firms will fall by the wayside because they're not paying attention to the physical and transition risks that their businesses are facing. Yeah. So, you know, there's risks, reduced profitability, reputational risk, as Catherine said, legal risk, you know, there's the risk of business model redundancy or the regulatory or even the social license to operate. So this really is coming into the heart of how a bank determines the creditworthiness of a client.
And given these broader initiatives and collective responses, Sarah, in terms of your role and discussions with banks, how perhaps you can touch on how flexible can banks be in terms of developing their own approach to delivering on these commitments, and you know, some of the more topical challenges that some of them have been calling out or discussing with you as these being developed and progressed.
Yeah, well, so I guess starting on flexibility, the Net Zero Banking Alliance framework is very much the discretion of the bank as to how the bank delivers on their commitment. So the commercial decisions of the bank remain, you know, your own decisions, and we do need to be very careful about antitrust rules and ensure that all the work that's done in the alliance is all on a pre-competitive basis. But the framework does set some kind of constraining parameters. So that's mainly when it comes to setting targets, we require the banks to use a really robust scientific scenario that's 1.5 degrees net zero by 2050, low or no overshoot, doesn't rely heavily on negative emissions technologies that are unproven at the moment, and also makes reasonable assumptions over nature-based solutions, etc. So those are definite constraints in setting the target, but how you meet that target is very much up to you to build a strategy for divesting, excluding, tilting your portfolio, you know, looking at carbon intensities of different clients. So that remains your commercial decisions. And I guess coming on to the challenges, you know, the obvious challenge is always data. You know, knowing your client's scope 1, scope 2, scope 3 data is still really not the norm. And so everybody's having to make assumptions and use proxies, etc. And this really has to change. So, you know, I would say, you know, listed corporates tend to be a bit further ahead, but now there's a lot of attention being paid to private companies. and even SMEs. There's lots of tools being developed to help them to measure their carbon footprinting. And I guess, you know, as I said before, the next challenge is that banks just can't do this on their own, and they need a policy environment that's conducive for the clients to make the green choice as a kind of rational economic decision. And so, you know, in some sectors that's quite challenging. So in retail banking, for products such as mortgages, where there's thousands of small loans, the bank may not have so many levers that the bank can pull to get the clients to invest in better energy performance. And then I guess, you know, lastly, a challenge is really all around getting better breakdown of the scenarios. So at the moment, we're very much dealing with these sort of global scenarios for decarbonisation, but we need to get more granular. We need pathways that are more broken down by jurisdiction or region and by sector, etc., so that we can really see the way forward.
And Sarah, just before we move on to our next topic, the reality is different industries have different profiles and different roles to play in transition. Now, as we work through these commitments, you know, is there a potential impact on certain industries based on their emission profiles that we need to think about and have top of mind?
Yeah, I think, you know, most industries can decarbonise through technologies that we know now. So this is all around electrifying processes, greening the grid through the use of renewables, thinking about energy efficiency measures and using things like synthetic fuels such as, you know, ammonia, green hydrogen, biofuels, etc. And, you know, many of the oil and gas companies are diversifying and becoming, you know, mixed energy companies and applying, you know, their expertise in the renewable sector. But there are some sectors that, you know, everybody recognises are very challenging to decarbonise, and not all of those will be able to fully decarbonise by 2050. And we will have some residual emissions that have to be neutralised with long-term carbon removals. So we do need to make sure that we're really robust in and cautious in how we address that. So those are things like steel, cement, etc. And you know, what we need to do is kind of look at reconciling the top-down integrated climate modelling with the kind of bottom-up industrial-based modelling, which sometimes is even done sort of asset by asset, and really sort of seeing what the differences are there, and that will really help us with, you know, the client engagement and also policy advocacy to advocate for whatever regulation is needed to make that decarbonisation work. But, you know, that's not to kind of, you know, evade that there will undoubtedly be some very difficult decisions, and not every industry can transition and adapt its business model. So, you know, some carbon intensive assets will have to be wound down and decommissioned or retired. And actually within the Net Zero Banking Alliance is part of a pan-financial kind of umbrella called the Glasgow Finance Alliance for Net Zero. And they are currently doing some work with McKinsey, looking at different models for enabling you know, the retirement of carbon intensive assets in a responsible way that really thinks very deeply about some of the just transition issues.
Thank you very much, Sarah. Now we might turn to our next topic, and we will come back to Sarah. But before we turn to David Jenkins, Catherine, I'll pass to you just in terms of introducing the sustainability activities and sustainable finance session.
Brilliant. Thank you so much, Rodney. I will share my screen again. Hopefully everybody can see that. Okay, so switching gears and talking about commercial activities, there are three main ways in which sustainability and ESG is incorporated into banks' activities. So the first of these is philanthropy, much bigger in the US than it is here, traditionally very valuable, not super scalable generally. I think you'll understand that. Corporate responsibility. These are activities that are pretty much expected of any bank by its stakeholders. They offer environmental and social benefits to the community, And for banks, they offer benefits in areas like improved productivity, reduced expenses, improved engagement. So again, very valuable. Common areas of focus within banking on activities around diversity, employee working conditions, energy consumption, water consumption. You get the idea. From a company perspective, it's very much worth keeping in mind that some banks are global leaders in many of these activities. NAB is very strong in quite a few of these activities and always very happy to share our knowledge. Okay, so let's move on to shared value though, because I think that's where things get most interesting. Shared value is all about reinventing a traditional way of doing business to incorporate ESG benefits. So shared value activities are usually revenue generating, or they're core to a bank's activities if they're not revenue generating, and they can deliver high value to society and the bank, because where you get an ESG benefit in there and it's a core activity, of course, the benefits scale as much as that activity can benefit, which is just great. So with that, we will I'll sort of get on to sustainable finance, which is probably one of, which is a shared value activity that's really changing the banking landscape and how we interact with our customers. So I'll just talk a little bit about some of the trends in shared value. Shared value, it's a broad church terminology-wise, and you'll hear different phrases used depending on sort of what risk is being targeted. There's a lot of press on sustainable finance, but it's actually a really small part of the banking market. So at the moment, sustainable finance accounts for about 1% of total global debts. On current growth rates, it will reach about 5% by 2025, 40% by 2030. However, it will evolve as it goes through this process, and we're already seeing it evolve. And with that evolution, let's start with where the evolution started. So that is with proceeds-based debt. So this is the original type of sustainable finance. We saw it first in 2007 with climate bonds coming out of Europe. No surprises there. They often lead. Includes green loans and bonds, social loans and bonds, sustainability bonds, and there's a whole range of subcategories coming in. Clearly, proceeds need to be used for a green or social purpose. That's the whole point of proceeds-based debt. Benefits are usually around, varies by bank, but usually around 5 basis points. The largest portion of the sustainable finance market counts for about 80% of the market. It's pretty straightforward. The limitations on proceeds-based debt, it all sits in that how the proceeds are used. There's only so many environmental and social projects in this world. So that brings us forward, and late teens, we saw behavioural-based debt start to evolve. This behavioural-based debt includes sustainability-linked loans, sustainability-linked bonds. What's great is behaviour-based debt is suitable for any company because proceeds can be used for any purpose, so long as a company you're willing to commit to KPIs and targets that deliver environmental and social benefits. The target that we're seeing most commonly by margin are sort of targets around decarbonisation, but these are entirely, there's a lot of choice around targets. They're not prescriptive. Again, there's a pricing benefit, some fairly strict criteria involved in putting behaviour-based debt in place. It's really important that targets are ambitious and authentic to avoid any claims of greenwashing, but we very much expect to see this market grow. Where we're seeing the last evolution is actually in a subcategory that sits within both proceeds and behavioural-based debt, and this is transition finance. And so transition finance, as the name suggests, is associated with decarbonisation activities. And what we're seeing, there are some very clear guidance principles associated with transition finance. It's not a term you hear used much, but the guidance principles actually get used in a lot of different types of sustainable finance. And the guidance principles are around climate strategy and governance, environmental materiality, having science-based targets, and implementation transparency. And what we're seeing is that outside the sustainable finance market, banking executives and bankers are increasingly starting to request that these types of transition finance principles be adopted, even where sustainable finance has not been put in place. So it could be for a project finance activity or something like this. And this is just this familiarity with key sustainable finance principles and this sort of willingness to request them in other circumstances is, I think, where we're at the very beginning of this trend, but where we're starting to see the next trend of sustainable finance really impacting and influencing broader markets and banking and how those markets work. And so that is one to watch out for. But I'll leave it there and hand over to Rodney and David Jenkins. And David Jenkins is an absolute global leader in sustainable finance. We have one of the oldest and most awarded teams, and is very much involved in shaping how this whole industry is changing globally. So thank you very much.
Wonderful, thank you, Catherine. And David, what are the to get us started, what are the biggest and most influential trends you're witnessing? What do you expect to see more of during 2022 in terms of sustainable finance markets domestically and abroad?
Thanks, Rodney. It's a very interesting market right at the moment. I mean, things are happening in real time at warp speed, it seems, especially with the events unfolding in the Northern Hemisphere. What we are seeing and what's happened since last year is just the unstoppable growth in capital being directed towards sustainable investing. And that's been combined with a rapid growth in the level of corporate sustainability ambitions, whether that be through entities signing up to net zero, the take up of science-based target initiative approved targets, the growth and demand for carbon offsets, etc. But more broadly, a focus on the full spectrum of environmental, social and governance issues at the corporate level. So we're now seeing the rise of focus on natural capital and biodiversity. So some of the global initiatives include the Task Force on Natural Capital and a real focus on how that impacts climate change, or the impacts of climate change and biodiversity, a focus on supply chain, the low carbon transition that we're seeing underway throughout the banking and investment sectors as well. Another area we're seeing is just the huge growth in the sustainable debt market itself. So by the end of last year, the market, the cumulative issuance had topped $4 billion US, and that probably a quarter of that was through the latter part of 2021. Now, this year alone, we're on track to far surpass that. The bulk of sustainable debt issuance has been in more traditional use of proceeds style investments, something close to 80%. And what we've seen this year is a focus on, again, more green labelled issuance, but the rise of sustainable linked issuance across both bonds and loans, and the emergence of more product types, so sustainability linked derivatives. Another area where we're seeing rising focus and growth globally is the focus on ESG and sustainable finance regulation. Now, here in Australia, we've seen that through the actions or the signals from the ACCC last week, where they've signalled that they will be focusing on greenwashing and claims of companies in their advertising, together with the work of ASIC. Now, they've identified greenwashing and some of the issues that relate to that as the key priority for them last year and ahead. We've seen that already happening offshore with the US regulators. But we're also seeing rising calls for standardisation, simplification and harmonisation of disclosures and reporting as it relates to sustainable finance, because it's a bit of a word soup at the moment. It seems that every other week there's another taxonomy in development. So we will see a lot more action in that space this year.
And David, given our clients that are on the line, just in terms of recommendations from you, things to keep in mind when you're considering sustainable finance, obviously there are some that are more new and some that are more experienced. So perhaps your views to sort of both of those groups.
Sure. So it's been interesting to watch the emergence and some of the advice that's come to the fore here. And certainly we've seen numerous law firms give guidance off the back of legal opinions. And last year we saw Noel Hutley SC come out with another legal opinion around greenwashing issues. And part of that is really focusing on minimising the opportunity for greenwashing claims. And in that regard, the trends that I touched on earlier will only continue to accelerate this year. They'll need more focus, more expertise internally on global borrowers to both react to expectations of investors, but also to give them comfort that they're addressing the risks that they're facing. So that means being ready to defend and describe if they do make claims and commitments. Do they have a well-considered and articulated plan to actually deliver on those net zero ambitions? Do they have interim targets? On what basis are they made? Are there science-based targets to support them? And if they do have financing that's coming to market, is it true to labels? So if it's in fact being labelled as green or sustainable, on what basis is it being made? Bearing in mind that the burden of proof continues to rise, and a much higher standard of conduct is starting to emerge both domestically and abroad. The other thing to consider is, for those more experienced with sustainable financing, is there will continue to be a rise in expectations and requirements from investors on disclosure, more scrutiny on claims made by investors and by banks, as banks themselves move towards disclosing their own transition plans and near-term decarbonisation targets and pathways. They will be expecting their borrowers to provide them with more information. The pressure will continue to increase on corporate boards from both shareholders and regulators to demonstrate they are in fact equipped to understand and address these ESG issues. And we'll just see that continue. So in essence, what may have been acceptable and market practice as recent as 12 months ago, I think the bar has moved substantially since then.
And David, if we link back to the discussion with Sarah and Catherine around the CCCA and NZBA, what do you see as the opportunity for companies associated with the commitments that these banks are making?
So that takes many forms. It could be through, as banks move to decarbonise their balance sheets, then clearly they will be looking to reduce their exposures to carbon-intensive lending, but also increasing their exposure to companies that are focused on that climate transition as well as green lending. We've already seen examples of that offshore, with some offshore banks applying internal risk-weighted asset models that allow or incentivize bankers to lend more towards greener as opposed to browner lending. Banks are very much focused on how are they going to deliver on those net zero ambition claims, the level of engagement that's already underway with banks talking to their customers about transition plans. And with that comes the opportunity to benefit from pricing advantages for greener or more sustainable lending. There are more opportunities to enter into a range of different financing solutions that support companies in their transitions. So sustainability-linked financing is an area in particular. Catherine talked earlier about transition finance. We've seen transition finance mainly taking the form of sustainability-linked debt, where companies are signing up to accelerate and hold themselves accountable for their climate transition, whether it be through reducing absolute emissions, reducing their scope 1, 2 and 3 emissions, commitments they're making to meet and beat their net zero targets. And the other thing is just collaboration with banks more generally. I mean, the banks through the forums like the Collective Call to Climate Action, the NZBA, are sharing learnings on portfolio decarbonisation trajectories, sharing information and best practice around how to calculate their carbon footprints. Clearly, things like scope 3 emissions measurement and reporting are a big challenge. If they're a challenge for the banks, they're much more challenging for corporates. So banks are more than willing to share those learnings with corporates, I'd suggest.
Thanks, David. And Sarah, what about from your perspective? You're in a slightly different position, a different seat. So, how do you consider sustainable finance in the context of net zero commitments?
Yeah, I guess I suppose there's three things I'd like to highlight. First, I think comes back to what Catherine was saying about the innovation in terms of products, and I guess that's products on both sides of the balance sheet. So, you know, there's a huge role for innovation and to issue green bonds and sustainability linked bonds, and you know, to raise funds for green investment and help clients transition. So there's, you know, green mortgages, green loans, and also savings products and investment products. So you know, I think there's that innovation in terms of the offering. But then I think over time, what's going to happen is the scope of net zero commitments is going to grow, because at the moment, banks are really very much focused on the lending and investment activities. But I think in time we'll see that, you know, within these targets for net zero, we'll start to see the activities like the capital markets activities, so IPOs and the raising of debt and equity and things like that. So over time, you know, there'll be an increasing portion of the balance sheet. And then I guess the third trend is really the need to mobilize more capital into emerging markets and developing countries, because at the moment the capital just isn't there to help them adapt to climate change that is now inevitable, or to help them achieve clean, sustainable development. So there's loads of opportunity to blend public and private finance to achieve these sustainability goals.
Sarah, you mentioned emerging markets, but are there other trends in sustainable finance the UNEP would like to see develop going forward?
Yeah, I think, you know, a lot of what we're doing in terms of developing the frameworks that we're developing is really aiming at norm setting. So, you know, what we're trying to do is take these gnarly problems and work out how to approach them and develop approaches together with the private sector, and ultimately have, you know, what was once seen as maybe quite radical or new just become mainstream. And so there's a lot of awareness raising, but development of methods, data, and all of the infrastructure that will make it easy to implement these things. And I guess another trend we'd like to see is really the convergence around international reporting standards, and for those to be, you know, consistent, mandatory, ubiquitous, really, and across public and private companies. So we hope that the formation, for example, of the ISSB, the International Sustainability Standards Board, will help to bring about some convergence in that area. I guess also, aside from the reporting, you know, there's convergence around methodologies for carbon accounting and target setting. So, you know, I heard somebody say earlier, there is an alphabet soup of initiatives out there, and it's really complicated for people to navigate. So I think, as with all young fields, there's always a sort of burgeoning of initiatives and approaches, and hopefully we'll be able to kind of start to hone in on defining best practice over the coming years. And then I think lastly, you know, one thing we would like to see is that as these sort of voluntary initiatives become more normal, that this will start to work its way through into regulation. So obviously regulation has been very focused on the risk side of things, but, you know, mitigation is the best, mitigating emissions is the best risk mitigant as well. So, you know, let's hope to see this impact side of things work through into regulation a bit.
And Sarah, given it's a topic that you know, I touched on with you a bit earlier, but it's one that comes up so often, and particularly with many of our clients and conversations with them, just to coming back to heavy emitting industries. And when we think about transition finance and how essential that'll be for companies in these sectors, how does bank funding of transition activities work in the context of net zero commitments? And you touched on this a bit earlier, but we're talking about sort of transition finance. You know,
Yeah.
You know, we get questions from customers around, you know, availability of increased funding for higher heavy emitters, if it's for a transition purpose, as an example. Is there anything from a sort of UNEP FI perspective you can share and thoughts around that?
Well, I think it is a really tricky problem because, you know, in theory, it could increase your financed emissions as a bank if you're investing in these very carbon intensive companies and helping them to do their transitioning. So we do actually have a whole work stream on this within our implementation work track, which has only recently started, but I'm hoping that we'll be able to come out with some good guidance for our members. And, you know, there's quite a few things we're going to need to think about. For example, how you attribute the emissions from those transition activities to the financial institution, how you disclose and what incentives there are. But I think, I mean, Catherine spoke earlier about a bit of a distinction where the use of proceeds is clear. I think if the use of proceeds is really clear that it's going to lead to improvements in emissions profiles, and that's really certain, and it's going to be very meaningful in helping the client achieve the net zero goal, then, you know, that hopefully will be a lot more straightforward. I think when it comes to more general purpose financing, that's really going to come down to the client's decarbonisation plan and a focus on their CapEx plans and having strong governance around that. But you know, we know that the decarbonisation pathways are not going to be nice and neatly linear. They're going to be lumpy because there's big capital investments. And I think, you know, hopefully transition finance is an enabler, and it brings a, you know, positive feedback loop to accelerate that real world decarbonisation that I talked about. But you know, it's a challenge to define what is the best available technological alternative and how do you prove that, and where does the burden of proof lie on that, and can we use sectoral sort of technical screening criteria or government-led technological roadmaps. And one issue is that, you know, we don't have a transition taxonomy that sets out what is acceptable transition finance. And I know that's being worked on at the EU level, but it's, I think I said earlier about the issue of lock-in, and it's really important that we have a mechanism to avoid that lock-in of emissions, because, you know, large capital expenditure often funds capital that has a lifetime of a decade or several decades. And, you know we have got to halve emissions every decade going forward. So we've really got to think about what we're locking in with those decisions, and that's got to come into the transition finance decisions.
Sarah, just in the interest of time, I might just turn to, we've got one question for you from one of the members of the group, back to one of your favourite topics, the challenge of data. And the question is, are you able to share your view on whether regulators should be elevating data quality and accelerating transparency? And are there any examples that you can think of in your role or travels around regulators doing this globally? Obviously, there's a comment here noting you mentioned private company information as a challenge, and this is growing with super funds, private equity investors taking more and more companies private. Yeah.
And we've seen a lot of that over the pandemic. There's been a real growth in assets being taken private. And obviously, historically, there's been a lot less transparency in that area. I think, yeah, I mean, you know, definitely very, very pro a lot of the initiatives that are aiming to get more data to be mandatory and open and disclosed. Back when I was working at the Bank of England, I was part of a task force, and we looked at how to develop a roadmap in the UK for better disclosure, and we very much modelled it on the TCFD model, which again, it maybe isn't quite as prescriptive, and there's a lot of latitude within the TCFD framework, but we worked across a whole range of regulatory bodies. So we worked with the Department of Pensions to look at the pensions and the pension regulator. We worked with the FCA which looked at the listing rules. We worked with government departments, BEIS and Treasury, to get it into the company law, so that would capture private companies, for example, and obviously the Bank of England had a big part in that. So yeah, we really need to take a very sort of holistic view to try and bring the whole, the whole data picture along, because, banks can't just miraculously rustle up this data. It's got to come from the real economy. But yeah, I think, hopefully there's, like I said, the ISSB will be a big thing in that. And even there's lots of work underway on private assets at the moment with organisations like the CDP, ICI, ILPA, and GRESB, etc., and the PRI. So there is a lot of attention being turned to those areas now. So I think we'll see a lot of developments over the next couple of years.
And we're coming up to the hour. We always promise to make sure, particularly to our clients, that we do finish on time. So thank you very, very much for that, Sarah. Kath, I might pass to you.
Well, look, thank you. What an enjoyable session. And I think there's no client meeting that I have, and I have quite a few during the course of a week, that I'm not talking about our clients' transition, helping them soundboarding different ideas. Can I just say on behalf of National Australia Bank, a big thank you to Sarah Kemmitt. I've had the pleasure of getting to know her and share some of her insights, hugely valuable. A really big call out to Cathryn, Todd and David Jenkins, who have done a tremendous amount of work. It's their day job, their night job, and Rodney, of course, for hosting. So really thank you, Rodney Wallis. Again, we've heard some great stats. I think I love Sarah's comment, again, just putting it back into reality. We've got to halve emissions every decade. That's no mean feat. And I think we heard from David, whilst 4 billion was what we issued in sustainability loans or bonds last year, we're on track to surpass that unequivocally, I think, David, unequivocally. And lots of progress in that market. Again, on behalf of NAB, thank you very much for your time. I would encourage you to call, for the clients on the call, call your banker. This ESG and debt report is awesome, and we want to have more meetings so we can share with you and help you on the journey of greater understanding and getting fit for purpose, and obviously achieve your own transition goals and net zero goals. So thank you again. Have a great day.